I'm open to. I'm welcome. I'm ready to start if all of you are. What I was going to say is welcome back to this event. This looks like this is going to be a weekly regular gathering. Thursdays at 1 p.m. New York time. I'll look back at the past few days of trading, some highlights both in terms of setups and also in terms of just overall news flow and events and such which have seemed to have moved the market in the recent past. And we can take a look at times, hopefully more often than I have of late, take a look ahead at some of the events that can affect the markets in the future. And some of those events, by the way, some of the events that can affect the market in the future aren't events per se. It's not things that are even on news calendars, well, virtually any news calendar. And I've got an example. One of those, I call it I guess a scenario or a situation which can affect the moves of select currencies over the course of the coming weeks or even months. I'll bring one of those issues up during today. So had a comment yesterday from comment last week from one of the attendees of this event asking, looking like for a takeaway. What can help their trading? Well, I'll give you something that could potentially, at least one thing hopefully today that will potentially help your trading at least over the coming week. Anyway, welcome to this event, this webinar. Thanks especially to FX Street and everyone involved there to help make this event possible. And we're not just this event, but all the events that FX Street puts on. They do a wonderful job, and I'm both pleased and honored to be one of their now new regular webinar facilitators. First, let me remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but I will provide a review of the trading week that's transpired thus far. And again, we'll take a look ahead into the future, and both from a technical perspective on the charts, but also look at some news events and some things, some situations, as I mentioned a few minutes ago, which could affect the appetite for or not, or maybe I guess you'd say against certain currencies. By the way, this is not, again, remember I don't provide alerts or recommendations, but I do want to point out as a note here, this 1.2275 area on the Euro USD, represented by a horizontal orange line, it has been important in the past. It's affected at times intraday price action on this pair. And it's difficult to see the evidence of that on a 4-hour chart, which I'm showing now. I know there's a lot of lines in this chart, folks, and I'll discuss at times every one of these, or not every one, but a number of these lines, especially the lines in the upper half of this chart over the course of this nearly 1-hour webinar. But the one I wanted to emphasize was the horizontal orange line at 1.2275. It's affected a lot of intraday price action. You'll see on this 4-hour chart, there's maybe a couple lows and a couple highs near 1.2275, but the origin of the line, the reason I put the line on my chart several days ago was we just had several examples on several different days of price turning either from up to down or from down to up at or near 1.2275 on the euro. One good way to start, I think, this review is to look at the euro's price action this week, and that you may notice a double top with Monday's early Asian session high. Let me go back to my 15-minute chart. Now I'm going to go actually to a separate chart on a separate profile here on this MT4 platform. I've got a separate euro chart that's a little bit cleaner looking, a little less encumbered, if you will, by multiple lines. And this is exactly the chart I wanted to take you to. I've got a horizontal purple line at 1.2440. I discussed this in a recent New York session video review. I post reviews of many New York morning trading sessions on both FX Bootcamp's blog at fxbootcamp.com, also posted on a blog here at fxstreet.com. So watch for those periodically. I will post, not every day, but most days, a video review, a summary of price action of at least a trade or two taken or discussed at least during the New York morning session. And in one of those recent video reviews, it might have been yesterday's. If it wasn't, it was Tuesday's. I discussed this 1.2440 area. And let me activate the drawing tool here. I mentioned 5 separate lows established in June. I'm highlighting those now. 5 separate lows, each within about 5 pips of 1.2440. Now, I don't know if that's the reason, by the way. You can also identify a high established in late May right there, also very close to 2440. Whether that's the reason, perhaps there's a fib level of an earlier move down here, or there's possibly a number of other possible factors that could have dictated the recent highs on the euro here on Monday and Tuesday. Actually, another thing I can add, of course, this could be based on historical price action as well. I've heard talk about a option barrier at about 24.50. So in other words, there could be traders shorting the euro at earlier this week at or below 24.40 in defense of options. Perhaps no touch options. Those options go or expire worthless if the price touches 24.50, if that was the nature of the options that are in place there. So whatever the case, you've got notable resistance to 24.40. The euro had ample opportunities earlier this week to break above it. In fact, you don't see it on this chart, but the early part of Monday's Asian session, there was a notable flip or shift from up to down on the euro. The euro jumped in early Asian session trading on a Monday and flipped fairly sharply. And we also, again, we have the test of that 24.40 level on Tuesday as well and held. And we discussed, by the way, a trade based on that level, that area holding during Tuesday's New York morning session. In fact, that trade, interestingly enough, it's probably a good segue here. Let me go to a shorter-term time frame, namely a 1-minute chart. We discussed a couple things. I'm looking at a 1-hour chart for the Euro-USD. Quick summary, as I promised, about the one of the focuses of this event is a summary of some trades that materialized over the course of the week. One we discussed, probably best seen on a 15-minute chart. And then I need to turn off the auto scroll in this chart so I can scroll back in time. It was 2375. Let me make sure. Yeah, actually, you can see the flip on the upper. This is the left. This is the chart from Monday. This is essentially all of Monday's price action, plus a little bit of Tuesday's on a 15-minute chart. And you can see the notable flip from up to down on the euro in early Asian session trading on Monday. What we discussed during Monday's New York morning session was, well, first of all, we discussed how the nature of the euro's rally, or the dollar sell-off, kind of the same thing, on Friday, following the first point was it seems the market outdid itself and did a exaggerated euro sell-off on Thursday following ECB President Mario Draghi's comments. I think we addressed that to some extent in the webinar last Thursday. But then Friday, what we got was a notable euro rally. The euro-USD had recouped, I believe, more than half of Thursday's losses from high to low on the euro-USD, and then we got the NFP report, better than expected headline number from the U.S. jobs report, and the euro then kept it going up from there. So it was certainly reasonable to assume that there could be at least one more shot north on the euro, one more round of euro buying, one more round of dollar selling, again, the kind of interchangeable in the early part of the trading week. And so we looked at the euro charts here on Monday, and let me get the drawing tool going again. And what I saw was this. You see some hesitation there in early London session trading, a high there. And in the hour or so, actually more than an hour before the U.S. equity market opened, we get a low there. So it's like, maybe it's just me, but it seems the 1.2375 area, which is right in here, has affected price action. Now, was there any history of that? I didn't notice any, but perhaps there was at some point back in the distant weeks and months. But whatever the case, whatever the reason, 2375 was important. Now, this trade, the prospect of a long at 2375, that came together. There was if you didn't take the long earlier, right in here, the long trade on Monday on the euro at 1.2375 right there. And it was an interesting trade for a couple of reasons. Number one, we saw volatility increase, as we often do, not always, but often do, around the U.S. equity market open. I noticed this, it was like February of last year, and maybe it occurred before then, but I first really noticed it as a fairly recurring pattern. Again, not every day, but very often, that volatility would increase in the currency market, especially on the Euro-USD, starting either minutes before or minutes after the opening bell on the New York Stock Exchange. And that euro long, so what we had was this, the euro at support, at that prospective support, a level that had been support earlier, resistance more recently, support again here at the U.S. equity market open. Oh, by the way, the other clues about that suggest a more up and down. Consider what London session did. The London session started here. That was about the start of London session trading. So it was euro down during Asian session, down modestly during London session. There was about a 30-pip drop here. But notice what happened since then. After about the first 90 minutes of London session trading on the euro, we get the low there. And by the way, this low, the low I'm highlighting right now, that's a mere maybe 10 pips above the 2330 level, which has been so important over the past several weeks. Anyone notice that, 2330? You might call it the 2320 to 2330 area has put a lid on the euro many, many times over the past several weeks throughout much of July. And sometimes what you'll get is not an exact retest, but a near retest of important levels like that. So the euro falls within about 10 pips of that 1.2330 level and stalls. And then you get some higher lows here. So I guess my point is this: and let me redo the drawing tool here so we can reset this, get rid of some of these other markings. So the market had every chance to push the euro lower, and that was the first attempt by the market to push the euro lower. And after that low there, you get a high there, higher lows here and here, a higher high there. And again, the prior knowledge that the 2375 area has affected price. And so you get the prospect of another higher low there, euro at prospective support, again, the 2375 area, at the U.S. equity market open, bingo. That's go time if you're a euro bull. And the challenge with that trade, which I think is an interesting trade worth discussing here for just a couple minutes, the challenge with that trade was really in managing this trade. The 1.24 psychological level about right here. Actually, my line's a little high, but somewhere near there, 1.24. And just like any psychological level, it could attract some brief attention. In this case, a prospective source of at least temporary resistance. So here's what we discussed. I was discussing very much of the coaching session that day. The question was, how do you manage that trade if you took the long right in there or somewhere in there, just above 2375? If the euro flips briefly or finds at least temporary resistance at 124, yet if you put yourself to break even after it reaches say 124, I know some traders who have basic rules about moving a stop loss to break even after the trades attained a certain level of profit in pips. Common rule in the past we've used at boot camp. When I first joined FX boot camp, one of the common rules we used at the time was 15 pips in profit, move yourself to break even. And some traders still do that. And I'm not knocking such rules, but in fact, I highly endorse everyone applying specific rules of trading and sticking with those rules. And in fact, if you break such rules, in fact, I like the coach of our advanced trading room, our room for advanced traders, Christian Stevens at boot camp. He's got a list of his own rules about trading, and he's got another strict rule that says if he breaks at least one of his rules more than once in a trading session, he's done. No questions asked, no exceptions. He is done. And so my point is, one of your rules may be a certain number of pips, and move yourself to break even. What I'm about to discuss here is at least potentially an alternative way to do that, to manage a trade, because I find personally that using rules that are based on a certain number of pips, those rules can be more or less effective depending on the volatility in the market. Does that make sense? moving your stop to break even if in a market where it's that's more volatile, maybe more or less effective than moving your stop to break even when you're 15 pips of profit, and also to depend on currency pairs. Some currency pairs that makes more sense than others. Well, my general strategy is to move your stop to break even based on a long a rise above the next logical level or area of resistance, because I've seen. Let me get the drawing tool going, or let me get the. Oh shoot! I'm going to draw this separately. I'll draw it over here. I've seen this happen far too many times. You take a long there, you have next level of resistance there. So you get, say, a bounce. You're long, you encounter resistance, price stalls, dips back down, test your entry again. You get knocked out if you move your stop to break even already, and then up it goes. I mean, come on, how many of you have seen, or have not just seen that happen, but been a victim of that? I have. I, for one, have, and far too many times. I don't know about you, but I'm tired of that. especially in situations where you have reasonable conviction that your plan and your bias are correct. So, how do you avoid that? Well, we recast the drawing tool here. Here's what we discussed on this trade on Monday. So you're long around here, just about 23.75. It's because of the psychological level that 1.24 could be an issue, and as it turns out, the euro stalls there for more than 15 minutes, nearly a half hour, and dips. You see the dip right there. So here's what we talked about, and this is a very simple strategy. It's one way to do it, not the only way, one way to do it. When you're long at a level like this, and you've got a recent low, namely right there, park your stop at least a few pips below that low. At least you allow for a retest of that recent low or a near retest, which is what we got here. So again, those who moved their stop to break even, who entered here, they got knocked out. The trader who put their stop here a few pips below the recent low survived, and eventually the trade worked out. And that was a 30, 40 pip trade. Not bad. Not a good start to the week. And that takes us to Tuesday. We were talking about this 2440 area. Of course, again, the high for Monday, very close to 2440. Market rumors about option barriers just above that. So there might be some speculators, even some retail traders looking to defend their options and keep them profitable. So there might be some notable selling around 2440. Also, as I mentioned earlier, the 2440 area seemed to be important on several days back in June. So the 2440 area is certainly a challenge for the Euro bull. Now we get during that New York morning session on Tuesday, we got a notable drop on the Euro here. Let's see the notable red candle. So the trade we discussed, one trade we discussed was a short. Let me activate the drawing tool again. Right there. You get the sharp right, a little bit of an intimidating short given the green on that candle there. But if you were conservative, you waited perhaps for a candle or so, and once you got price stalled there, that was a reasonable short to take around 24.35, 24.30. Now that short didn't work as well as hoped. We didn't get a sustained drop below this level around 24.15. What we did discuss was the Euro USD as a guide for what the dollar might do, and actually. The price action on other major pairs pointed us to an Aussie short. And I don't know if I can show this. It'll require me to go to another profile here and adjust a lot of different charts to show you the scenario. But I can point you to the New York session video review I posted on my epicstreet.com blog for Tuesday. I talked about maybe on the video I didn't even show the signs, so maybe it's worth showing the signs. What I saw was this. Some signs that the Aussie was broadly weak. Now, perhaps, why would it was weak on Tuesday? Well, maybe had something to do with the rate decision and policy statement issued by the Australia Central Bank during Tuesday's Asian session. And there wasn't any sort of revelation by that central bank, the RBA, during that Asian session on Tuesday. I don't know if it was just, profit taking on obviously long positions. The Australian dollar has been so strong of late. By the way, I want to discuss that, the Australian dollar and some of the reasons it might be strong later in this webinar. But whatever the case, we saw some signs that the Australian dollar against several other major currencies was showing some weakness. So the plan that day that we discussed was you have reason to believe, using the Euro USD as a proxy or guide for the dollar, some reason to believe that the dollar could at least rally against the euro. And not always, but quite often, when the euro drops, we also see the dollar rally or strengthen against other major currencies. So you add it all up, you have the prospect of a dollar recovery, and you have signs of lingering Australian dollar weakness. So weak Australian dollar, strong dollar built the case for pointed to an Aussie short, which I can show you an Aussie chart here in a moment. I'm thinking about leaving a short. Yeah, let me just go to the Aussie charts. Hang on. Quick sound check. I know I'm yapping away here, but I want to make sure you guys can still hear me. Everyone got sound okay? Thank you. Yeah, the short we discussed, I can see on the chart now. I'm just going to need to turn off the auto scroll here. The short we discussed, what day was that? It's 7th, right? Yeah, it was right in here. This is the bulk of a Tuesday's price action on a 15-minute chart for the Aussie. And what I saw was this. Well, first of all, you can see in the left middle portion of the chart the reaction to that's the reaction to the RBA rate decision and policy statement. Again, no change in rates by the Reserve Bank of Australia, and there's still some speculation about what their next move could be. Some think it's they're going to cut rates later in the year. Others think it's maybe they're done with their recent rate cutting cycle. Market's going to figure it out in the meantime. But what we did see is this: the Aussie, in the minutes after that rate decision was announced from the Australian Central Bank, the Aussie reaches 1.06 psychological level. Does so again just before the open of the London session that day, and has been down more than up since. Now, you may have already forgotten it, and you can check it separately on your charts. Anyone who cares about the player's full game at home, look at the Euro chart. Look back at the Euro chart I just showed you a moment ago. That Euro chart showed Tuesday's price action. Well, you could actually look at a chart for pound-dollar currency pair on Tuesday as well. My point is this: the Euro and the pair known as cable kept rising during the London and early part of the New York morning session that day. Well, look what the Aussie did. While the Euro and the British pound were both rising against the dollar, rising further. Eventually, again, as was discussed a moment ago, the Euro eventually found a ceiling at its Monday high. Well, the Aussie was stuck here, lower highs. The Aussie is stuck at lower highs compared to its earlier highs in the day. So that was one big clue. While the pairs known as the Euro and cable had made new highs for the day, the Aussie had failed to make new highs for the day. So that's what we discussed, the prospect of an Aussie short, and that the short we discussed was right in here. As the Euro was paused just below that 2440 area around the U.S. equity market open, the Aussie was right there. Notice the earlier lows here, and some highs established before the RBA rate decision right there at all about the same level, all around 1.0585. So that was the Aussie short. Now, that wasn't a huge profit maker. I've got a great mic. Oh, thank you, Mike. Yeah. Mike says I have a great mic. That means a lot to me coming from Mike. So yeah, so there's the Aussie short on Tuesday, and that was really just a combination of speculation of what the dollar might do based on price action on the Euro USD, plus again profiting from signs, from clues that the Australian dollar was uniquely weak. Again, the Australian dollar weakness perhaps attributed in part to either profit taking or perhaps even some renewed speculation that the RBA was going to lower rates in the future. I'm not so certain about that, but there still seems to be some speculation about the RBA cutting rates before the end of the year, particularly if the data out of China gets weaker. So that was one of Tuesday's main feature trades. And I didn't mean to get rid of that chart. And that, as I said, I'll scroll back on this chart, that takes us to yesterday. Yesterday's trade, I don't know if it's one of the more straightforward trades we've had in a while. Actually, I can show them a market overview. Expanding the 15-minute chart for the euro. Right here. Remember that 2330 level I mentioned earlier? 2330 level defined, actually the 2315 to 30 zone defined several highs on the Euro USD throughout the month of July. We broke above that Friday following the last Friday's NFP report. What was resistance, what was a sort of ceiling for the euro on several days and during the course of July became support, became a sort of floor for the euro. And really the challenge for this trade, and it's a little hard to see on the 15-minute chart unless I zoom in a little bit, which I'll do now. The challenge for this euro trade yesterday was sticking with it, was patience. So many traders, I count myself in this category, but probably to a lesser extent than some other traders. I'm by nature perhaps a little more of a patient guy, but nevertheless, this was a bit of a test of patience. The euro basically straddled the 1.2340 level for some like an hour to 90 minutes, and we thought we thought the euro might never stage a recovery and rally against the dollar, or maybe put another way, we thought the dollar would never weaken again or weaken significantly after that. After we discussed that euro long around 2330 during the part of yesterday's New York morning session. But what we discussed was a simple clues based on price action, and this is one of the reasons why I spend so much time on showing so-called naked charts without indicators. One of the simplest clues we discussed yesterday was this. Of course, you got the lows near 2330. That 2315 to 2330 zone have been important in the past. And if you look at the lows of the 15-minute candles here, I mean, they are higher lows. I won't disagree, Mike, that MACD was potentially a helpful factor there. But my emphasis is do not dismiss the irrelevance or the significance of price action in that one. Also, another point I mentioned as we were sort of passing time, waiting for this trade to unfold, waiting to see if the trade was going to work or not. Something I've noticed for quite a while, and this is for trades, for intraday trades, actually not just for intraday trades, but even for position or swing type trades. And I wanted to attribute the Pareto rule to this, the 80-20 rule, but I don't think that's the right proportion, and who knows what the exact proportion is. But the point I want to make was this, and I don't know how many of you have noticed this. How many of you have been in a trade and you just sort of gave up on it or lost interest in it and closed the trade, only to realize later, perhaps minutes later or maybe an hour later, that the trade not only worked but worked in a big way, and you left maybe half or 75% or more of your potential profits on the table. You let those profits go because you closed the trade too soon. Okay, that's another thing that I've been guilty of for too many times over the course of my trading career. And the point I want to make was this: it seems that not for every trade, but often enough, you get a good entry that materializes, like it did here around 2330 in the early part of yesterday's New York morning session, and then you wait. And sometimes, depending on your level of patience, depending on your perception of time, for those who are at a live trade, especially if you're a newer trader, it can seem like time just takes on a dimension. 1 minute can seem like 5 when you have live money at stake, or sometimes even longer. 1 minute can seem like even longer when you have live money at stake. But the point I was trying to illustrate during this as this trade was unfolding was this: it seems so often on at least a lot of trades that I take that the bulk of the profits come how do I put this? I use the 80-20 rule again. That the bulk of a trade's profits can come like in 20% of the time you've allotted to the trade. So you just use an example. Again, I don't want to get too hung up about 80-20 rule. It's not. I don't know if that's the right number. Maybe it's like 70-30. Maybe it's like 60-40. But this seems often enough to me, at least for my trades, that the bulk of the profits from a trade come in let's put it this way. We know markets move in waves, and if profits were in a move or distributed equally, the move would go like this. If you were long and the profits were accrued on equally each and every minute as each minute of the trade passes by, you get a move like that. Well, we know this sort of move, which is a steady rise up. It happens, but not very often. Not all that often. Unfortunately, not as often as what seemed to before the global financial crisis. What often happens, especially if you take a long, you get at least a little bit of a battle, as potentially the bulls battered the previous bears, which pushed the market down to set up a long if you're looking to buy on a dip. But yeah, this sort of thing happens far too often, where you just when you're ready to give up on a trade, or in the case of the euro trade I just discussed earlier, the euro trade from Monday, the euro jumps up, pulls back a little bit. You could have gotten knocked out if you're long on the euro from Monday's New York morning session if you move yourself to break even too quickly, and then boom! I mean, just near the very end of the session, the euro makes a higher high, and it really marked the difference between the men and the boys there. Those who moved yourself to break even were left with nothing. Those who give the trade both room and time to work, they got paid. And patience played a factor, I think, in yesterday's euro trade as well. And that takes us to today. Now we have this 2275 area holding up so far. Notice how the 2315 to 30 area responded again. I'll tell you what we discussed in today's New York morning session in just a moment. First of all, I just want to highlight the price action. Here's that zone I was talking about, the 2315 to 2330 zone. Notice how that was support earlier, resistance most recently. Folks, this happens all the time on the euro. A certain level, a certain zone. You may not see the euro, for example, reach a level or a zone for hours, days, even weeks. We get back to a zone like that, and all of a sudden, a zone which has been important in the past is important again. Now, what's notable about this recent move, the move down really ever since Monday's and Tuesday's highs, is if you, and I need to zoom out, and this is going to give you some perspective on moving forward here, what we can expect. And probably after I do this, I'll touch on the trade for the day. Setting off scroll in this chart, and let's go to a 4-hour chart. Maybe just me, but it seems like the market's still battling to figure out what to do with this pair. One of the inherent challenges with this pair, I mean, the volatility is still okay with the daily range on this pair, not quite what it used to be, but it's still the most liquid, the most heavily traded currency pair on the planet, and it still trades very technically. I just mentioned earlier, we've seen some logical flips from up to down or from down to up around 2330, for example. I just discussed a couple of trades that were logical trades on this pair, and even other pairs based on price action on this pair. The pair just does tend to trade so well, does tend to move technically so well. It's one I think even a seasoned trader should not ignore to make profits some moves on this pair. But if you look at this pair from a pure fundamental perspective, especially with regards to the two central banks behind these respective currencies, the Federal Reserve, as when it comes to the dollar, the European Central Bank when it comes to the euro. I mean, those two central banks are to varying degrees both very accommodative in their policy. Accommodative meaning, they both have, the Fed more so certainly than the ECB, but both have relatively low rates, low benchmark interest rates. And, of course, the Fed has outdone the ECB in terms of doing the so-called quantitative easing programs over the past couple of years or so. But, based on the comments made by Draghi at the ECB press conference last Thursday, perhaps the ECB is on the verge, if needed, or if they deem necessary, to do something close to printing the euros, although the Bundesbank and many major German officials are still strongly opposed to that. So that's going to be a major, you might say, even an accomplishment by Draghi if he can convince his fellow members of the ECB Governing Council to agree to that. But the ECB, to their credit, seems as willing to venture into uncharted territory as they have been perhaps ever in their entire history. So what I think the market's grappling with on the Euro USD is, for lack of other things, well, first of all, there's probably still some uncertainty about the situation in Europe. Has the ECB done? Is the ECB expected to do enough to at least shore up confidence in the near term in the Eurozone? I don't know. I mean, we'll have to wait and see. If you look at the rally from last Friday, which seemed like, again, due in part, as I mentioned earlier, Friday's rally, which, I missed the marker. So we saw the sharp sell-off I'm highlighting now, that sharp sell-off on the back of Draghi doing nothing when the market seemed to expect that he would do something, that the ECB would do something. We discussed this, by the way, virtually all week last week. We talked about how Draghi had seemingly some high expectations based on his comments at a London investor conference. That those comments about "believe me, it will be enough," the "believe me" speech, as I like to call it, sparked that euro rally there. Well, because Draghi announced no new initiatives, the euro sells off, probably more sharply than it should. But that sell-off on last Thursday on the euro, perhaps the degree of the sell-off due in part to rather thin markets. Thin markets means fewer buyers and sellers in the market. This is a very common vacation time for Europeans and even some Americans alike. So perhaps a somewhat exaggerated thin market trading conditions move on the euro last Thursday. But then last Friday you get the market digesting Draghi's comments, seeing that, Draghi did show some of his hand and seems willing for the moment to at least strongly consider some unique, unprecedented policy moves. So that gave it a euro boost during last Friday's Asian and London sessions. And then we got the better than expected NFP number, which boosted risk appetite, and up we go on the euro. Well, here's the point I'm in my typical long-winded way that I'm driving towards. We have yet another rally on the euro, greeted by, at least for now, some degree of selling. And, that's unfortunately that's been far too common, that any recovery in the euro, you beat on the back of, say, a comment or even a policy move of some kind, or a promise, a commitment to a future policy move by whether it's the ECB or certain leaders in the eurozone. You'll get often some short covering at the very least in the euro, some brief euro bullishness, perhaps for a day, perhaps for even several days, but it has not yet until, for now, it has not lasted. It has not lasted. So this becomes we're probably approaching an important point in the euro as to the Draghi comments from last Thursday led some to believe that that's the ECB's commitment. If they're serious about it, they fall through on it. It could be at least a notable near-term or medium-term game changer for the eurozone. Now, the Eurozone still has plenty of problems, still have structural issues in many economies, still need to reform labor markets in several countries and such. Several countries are still not very competitive at all with regards to labor costs and such. So there's plenty of Eurozone problems to be dealt with, and arguably nothing the ECB can fix those problems. And I think even Draghi recognizes that. However, Draghi's the ECB's commitment from last Thursday, may be just enough to, as time proves, maybe just enough to give the euro some relief. So this next week or so could be pretty important to see how much the euro can sustain its recovery. Again, recoveries on the euro following any notable move by any Eurozone leader, or following an EU summit, or following an ECB initiative such as the LTROs announced last December and activated in late December and late February of this year. Those relief rallies on the euro have been fairly short-lasting, have not stuck. So I'll be interested to see if this recent euro rally does stick. Well, one reason why the euro will at least have a rough ride up, let me show it to you. Rough may be a strong word, at least some speed bumps along the way. It's this graphic. First of all, can someone please confirm I see a graph? It's a bar chart. Actually, you might call this simply a column chart. A column chart over my price charts for the euro. Thank you, Mike. Mike, I think it's just you and me. A couple of us popped the comments in early. This was data released by earlier this week by the Swiss National Bank. Swiss National Bank each quarter publishes its foreign exchange holdings. Let me summarize the graphic for you. In the first quarter, back to the drawing tool again. In the first quarter, again, it's a breakdown of foreign currency investments by the Swiss National Bank. In the first quarter, and I'll explain why these have bumped up in a moment. In the first quarter, some 50% of its foreign currency investments were in euros. At the end of the second quarter and at the end of June, 60%. Thank you, Dan. Can anyone speculate why? Why is the Swiss National Bank or SNB accumulating euros or euro assets? What interest does the ECB have in buying anything related to the euro, or buying euros specifically? Anyone have an idea? Yes, thank you, Pizzazz. Pizzazz has got it. Essentially, the SNB, the Swiss National Bank, is defending 1.20 level on the euro-Swissy currency pair. Swiss National Bank does not want to see the Swiss franc appreciate or strengthen. In fact, you can look at it as 1.20 as resistance for the Swiss franc against the euro. It's actually support for the euro-Swissy currency pair, because of the way the pair is generally described as the euro is the base currency and the Swiss franc as the so-called core currency. So to put it another way, to put it in the terms of the way the SNB thinks about it, they don't want to see the Swiss franc appreciate against the euro beyond, or in this case below, that 1.20 level. And they've committed, this was last, August or September? The SNB committed to put all the resources they possibly could behind defending that 1.20 level on the euro-Swissy. And I don't need to show you a euro-Swissy chart. You can look at it yourself. I mean, the euro-Swissy has gone nowhere. It's been stuck just a few pips above 1.20 for weeks now, right? Virtually no volatility. Stark contrast, by the way, to the volatility that euro-Swissy saw in the weeks, especially in the weeks and months leading up to that commitment by the SNB. So here's my point with regards to not just the euro, but remember I mentioned earlier I would make reference to one reason why the Australian dollar perhaps may be a little bit bullish. Central banks, when they accumulate through whatever measures, in this case intervention by the Swiss National Bank, as some of you may be aware that China's central bank has on occasion accumulated a lot of dollars. That's one way they do this. It's as the Chinese exporters are paid in dollars by U.S. companies and such, paying for China's products. You get China's companies exchanging those dollars for the local currency, the renminbi, and so China ends up with a lot of dollars. And of course they pay a lot of those dollars into say assets such as treasuries, which has been a source of downward pressure on treasury yields for quite some time. And of course, I can go on to another tangent on how that's affected the U.S. economy over time. Our point is this: as China has accumulated dollar-based assets, it's created a disproportionate amount of U.S. dollar-related assets compared to other currencies. So the China's central bank has over time, through its policy of being a net exporter and keep its own currency weak and such, it's accumulated a lot of dollars and dollar-based assets, and as it diversifies out of that, as it sells some of those dollars and rebalances and tries to rebalance to a degree that they prefer, fewer dollars and more of other types of currencies. One of the benefactors of that has been in the past, especially when the global economy has been going better, has been the euro. So in my typical long-winded fashion, the point is this: one source of support for the euro in the past, especially when the global economy was doing better and China was doing better, one source of support for the euro has been China diversifying out of the dollars it has accumulated, diversifying out of dollars into euros. Euro, a next best, natural choice as the closest thing probably the world has for now to a reserve currency. Now, compare that to the case of the Swiss National Bank. The Swiss National Bank, unlike the China Central Bank, hasn't accumulated a lot of dollars. Swiss National Bank has accumulated a lot of euros in the process of defending them, again, 1.20 on the euro Swissy. So the Swiss National Bank will presumably over time could look to whittle down that accumulation of euros. So what does that mean? Well, it can mean a combination of selling the euro on rallies. The Swiss National Bank is believed to have done that already, and on occasions when we've seen the rise in the euro. Perhaps they even did that to some extent around the 24.40 level earlier this week. So that's one side of the equation. The euro on rallies could encounter some SNB selling at times. But think about what the SNB is doing. They're going to be selling euros or euro assets and putting the funds into another currency. Perhaps, and I stress the word perhaps, the Australian dollar. Swedish krona, by the way, is another currency that's believed to be a so-called diversification currency. So maybe that's perhaps one of the more relevant points I'm making yet today, and it's actually a point that could help your trading over at least for the next week or so. My reference to, let me type this in the room here, a so-called diversification currency. Oops. A diversification currency. And the Australian dollar, to at least some extent, may be just that. So for those who are wondering, why is the Aussie so strong of late? I don't know if that's the biggest reason. In fact, I would argue it probably is not the biggest reason. But I would argue, just trying to reset this drawing tool here. There we go. I would argue a reason, at least a contributing reason for the Australian dollar showing some recent strength, perhaps at least a bit of diversification by the S&B of their foreign exchange portfolio. And I think I mentioned other reasons in my prior seminar on the webinar on the last Thursday. Maybe some of you didn't hear it, so a real quick recap. Interest rate, yield spreads, interest rate differentials. Let me find this the graphic on this, or the graphic describing that. Where is it? There we go. Now this graphic is out of date. It's probably about 2 weeks old, so you'll have to check recent yields for an updated version of this. But I do have highlighted on this chart as of 2 weeks ago or so, the yield on the 2-year Australian government bond. That yield was was 2 weeks ago around 2.5%. In fact, if you bear with me a minute, we can check it again. In case you're wondering how I'm doing this, a simple way to do it is doing a Bloomberg search, using Google to search Bloomberg for their 2-year yields. Actually, I could go to Bloomberg's market data section, which I'm doing now, actually. The Australian 2-year finished the day at 2.94%. The U.S. 10-year, I know, by the way, around 1.7%. Oh, I'm sorry, that's a 10-year, not the 2-year. So I don't know what the U.S. 2-year is. But the Australian 2-year around just below 3%, and that, if I activate my marker, is right here. Actually, I can take a really quick look at the U.S. 2-year yield. It's 0.27%. So let me give you let me break it down really simple. The Australian 2-year, this is as of today, as of probably minutes ago. The Australian 2-year yield about here. The U.S. 2-year yield, 0.27%. That's about right there. It is that difference. That's a classic example of yield spreads, bond spreads, interest rate differentials. Call it what you want. Money. The idea is, when money flows to where it's best treated, and investors, global investors who are seeking a safe place to park their money, yet hopefully earn a little bit of return, earn a little bit of yield as well. Let's say they're looking to park their money for 2 years. You have a choice of a number of different countries, some of which are listed on the right-hand side of this chart. You can park your money at very low yield, relatively low yield in Germany. You can actually park your money in Switzerland and pay for the right to do so. The 2-year yields in Switzerland, last I recall, are still below zero. Or you can go to park your money in Australia. So to the degree that yields in Australia are higher and poised to rise, to the degree that difference in the 2-year yield, for example, or even the 5 or 10-year yield, to the degree that difference might get wider or get bigger, that is a positive for the Aussie USD. Is it the only factor? By no means is that the only factor. Yeah, by the way, that's Pizzazz. That's a Financial Times chart. That's something they put together about a couple weeks ago. Pizzazz, there might be a Reuters. Thomson Reuters updates a number of charts pretty regularly. I don't know. If you'll stick around after the conclusion of this session, I will. If FX Street, the folks there are still leave this room open for a few more minutes, I can track down for you probably a graph that shows something similar to this and is updated virtually every day. I don't have a really accessible now, but the other option is you can go to and look at it this way. Thank you, Mike, for the update on the Bund. What I'm looking at now is this: Bloomberg.com /markets, rates, bonds, government bonds. I think that's where I'm at. I think it's that link alone will do it. Let me check here. Hang on. Oh, shoot, that doesn't work. Hang on. Actually, you'll have to go to the default choice when you go to government bonds is the U.S. So if you go there, and you'll see some menu options on that page. You can look at UK bonds, Germany bonds. So that'll give you just a reading as to it's not real time, by the way, but that'll give you the actual figures at the end of the day. But in terms of the graph and to be able to see how a graph like this one changes over time, I'd look separately for that. I'm almost certain that Reuters, Thomson Reuters, the folks at Thomson Reuters, by the way, create some very interesting, very beneficial graphs. And I think as I wrap up this session, here's what I'm looking at, folks. Here's what I'm looking at over the next. I suspect this kind of thing we're seeing here, where sometimes up, sometimes down. If you look at the time of the year, this is a very common time for, again, especially the Europeans, to take vacation. We have this is a very common time of year for probably due in large part to that, for several pairs to sort of stall out. I mean, we still get some intraday price action. It's still very tradable, but by and large, here's what I expect: that the market's just going to trade very technically. Maybe react to some extent to the news of the day whenever we do get some days with some news. But in terms of the big moves, the really big moves, we may not be until like late August, early September. And I say that not because, well, I guess in part because we have seen new moves unfold about that time each year, but also because the events on the calendar. Gosh, the Bernanke's Jackson Hole speech on August 24th, Germany's Bundestag, their parliament, votes on the Permanent Rescue Fund, the ESM, on September 12th, a Dutch election on September 12th. Of course, another NFP report coming out in early September. And also the latest look on the health of the Chinese economy will come around the end of the month, early part of next month. So those are things to watch for. And I consider this next 2 or 3 weeks a very good time to kind of, especially sharpen your technical skills, sharpen your, especially with some specific trading skills like entries and exits, or maybe perhaps holding trades. Whatever you struggle with, this could be a very good time to work on that. Preferably on a demo account, or if you're going to trade a live account, then perhaps if your focus is on a sharpening a skill as opposed to strictly making profit, then consider lowering your lot size in that case. Yeah, but one of the main points I want to make in this session was to emphasize at least one of the potential reasons for Australian dollar strength, which is as a diversification currency. The S&B and its diversification efforts could, think about what I just said. The S&B and its diversification efforts could both sell euros at times and buy other currencies such as the Australian dollar. Have you looked at the Euro Aussie lately? Let's take a look at that pair. Actually, minutes before I started this session, the Euro Aussie was at multi-year lows. Off those lows now. This is a Euro Aussie daily chart. I don't know when was the last time we were at like 1.16, if ever, on this pair. I'm zooming out the monthly chart, and I'm going back to going back to forever, and since the inception of the euro, we haven't been here. So if we've been to this level before on the Euro Aussie, it was it was the whatever the Deutsche Mark equivalent was before the euro was devised. And this is actually another time and reminder that the euro is it may be hard for some of you to grasp, and even I have to think twice about this at times, but the euro, Europe's single currency, the euro, is considered these days a carry trade currency. A carry currency. Yes, it is. Euro Aussie, Euro pound. Many of these euro pairs have been dropping of late. But remember again, the dollar has at times, especially in the early part of the prior decade, first half of the prior decade, the dollar was a carry currency. So keep that in mind, that you have on the Euro USD, although it does trade fairly well, fairly technically, and there's ways to make profit from it, you do have, in the case of the Euro USD, probably one current carry currency and at least one past carry currency in the form of the dollar. the current currency being the euro, the house one being the dollar, and perhaps some think the dollar may eventually become a currency yet again. I guess you might say it is against the another currency like the Australian dollar. And I realize it's 2 p.m. New York time. This is the scheduled end time of my my webinar. I didn't want to take a little more time to cover the upcoming news and such, but as always, I've kind of run short on time. I hope this has been beneficial in some way. But I guess the thing I want to emphasize and keep in mind is that some of the forces that they may not be obvious from, say, looking at like news. The news events on the calendar, which are still important. Things like that, like the China news earlier today during the Asian session, still can set the tone for an entire trading day. But some of the bigger forces, like for example, actions by central banks, I mean, that may not be so explicit, so obvious to many of you. And so keep in mind, you have central banks like the one in Switzerland that are arguably very important influences in the currency market these days. So until we see the either the S&B either ramp up its euro buying or finally surrender and just back off, and maybe the Swiss franc sparks a notable rally there. And until then, we could see some diversification of their foreign exchange reserves affected the currency pairs at times, the euro, the Aussie, and perhaps other currencies. Yeah, Mike, and I still feel that way as well. I truly do. And folks, if any of you feels like that there's nothing more to learn, actually worse yet, if you ever feel like you've got it all figured out, especially in these times in this market, I don't know if I can impress on some of you enough how unique a time we are in right now. How unique a time it is. I mean, the yields we saw on several major government bonds, the German bonds, gilts in the UK, treasuries in the US, 10-year yields reached all-time lows several weeks ago. So many central banks pursuing so-called zero interest rate policy, or ZIRP, but many pursuing so-called quantitative easing. Now, quantitative easing was was started, if you will, by the Bank of Japan several years ago, but still, I mean, these are very unique times, and maybe it seemed like a struggle at times to trade the currency market. I'm telling you, we are because the time so many central banks are doing so many unique things, and because there's still some lingering uncertainty about the fate of Europe, or even the fate of the U.S. economy. Is the U.S. economy going to get out of the dungeon and start showing sustained recovery? Even there's some speculation about China. Is China due for a softer hard landing? Right now, it seems like the market, right or wrong, thinks that China is due for more of a soft and hard landing. But what if that scenario for China changes? I think it behooves everyone to pay at least a little more attention, or at least have some respect for the effect of news on the movements and price movements and currency pairs. Folks, have a great day. Thank you again very much, as always, to the fine folks at FX Street for organizing events like this one and for inviting me back. And I encourage everyone to take care and good luck with your trading. See you again in a little less than 1 week from now. Cheers.